Let's start this deep dive with a number, and it's a staggering one, $408 billion.
It's almost impossible to really fathom.
Right. That is the amount of shareholder wealth that just vanished from Oracle's market cap. And this is between September 2025 and start of this year, January 3rd, 2026.
In just 115 days, it's an incredible contraction.
Over 40% of its value gone.
Right.
Now, that sounds like a total disaster, a market crash, but our sources are suggesting something. Well, something far more structural is happening here.
Exactly. That $400 billion figure, you can't ignore it, and it absolutely feels like a crash. But to just call it that, to say it was just a fear-driven event, I think that misses the point entirely.
Okay.
This is what analysts are calling an epistemic shock. The market wasn't just, reacting to some vague skepticism about AI. It was performing a fundamental, really granular reassessment of Oracle's entire identity.
And that's really the core of our deep dive today. This transformation, it seems like a forced, rapid evolution from this stable, predictable software company,
High margin, yeah.
high margin, into what sources are now calling a leveraged AI infrastructure provider. So our mission here is to unpack all this and figure out if this massive repricing is, rational de-risking by the market, or if we're looking at a systematic undervaluation of a company that's bet everything on the future.
And that bet is all centered on one thing,
Mm-hmm.
the Stargate initiative.
Yeah.
The argument that comes out of this is, well, it's striking. Oracle has basically become a quasi-public infrastructure entity.
Meaning its success no longer depends on selling software licenses.
Less and less. Its viability now depends on the successful commercialization of AGI and at what is really a civilizational scale.
It honestly sounds like a sci-fi movie pitch, but the numbers, the commitment, it's all very real.
Oh, it is. And the Stargate project, it didn't just appear overnight. This came out of these intense, confidential negotiations between OpenAI, Oracle, and SoftBank that started way back in 2022.
And then it went public.
Right. It wasn't until January 21, 2025 that President Trump formally announced it at the White House, which immediately framed it as this, strategic national project.
And the scale of that project is just, it's almost unbelievable. A commitment to deploy up to $500 billion in AI infrastructure by 2029.
$500 billion, with $100 billion of that for immediate deployment. It's a bet the size of a small country's GDP.
So who's paying for all this? The financing structure seems interesting.
It tells you everything about the risk they're taking on. It's all built on this asymmetric risk distribution. So you have SoftBank and OpenAI. They each put in $19 billion for 40% stakes.
Okay.
Then Oracle and Abu Dhabi's sovereign wealth fund, MGX, they each contributed $7 billion. But here's the crucial detail. The fine print says SoftBank bears the financial responsibility, but OpenAI, they retain operational responsibility.
And Masayoshi Son is chairman.
That's right.
So that split is fascinating. It means Oracle, who's actually building all this, is concentrating all the execution risk on OpenAI's performance.
Exactly. It's a massive, massive dependency. And let's talk about the tech here, because these are not your grandfather's server farms. Stargate is a completely different animal.
The flagship campus in Abilene, Texas. That's the template, right? It went live in June 2025.
It is. And as of last month, December 2025, Abilene already houses over 96,000 NVIDIA GB200 racks.
That's the brand new Blackwell architecture.
The absolute cutting edge, floor to ceiling. It's an unprecedented concentration of frontier AI hardware.
But the real shocker, I think, is the power requirement.
Oh, absolutely. The Abilene site alone is projected to consume nearly 1 gigawatt of continuous power.
1 gigawatt. Let's just put that in context for everyone. That's roughly the electrical demand of 750,000 American homes.
It immediately shifts the whole conversation, doesn't it?
Yeah.
This isn't just corporate strategy anymore. This is utility-scale public infrastructure. Oracle is now directly competing with major cities for energy.
Which explains why they're expanding so aggressively everywhere. They're just hunting for power.
That's the game. They've got capacity approaching 8 gigawatts committed in the U.S. alone. You have Shackleford County, Texas, at 1.4 gigawatts. Saline Township, Michigan, they call it the Barn. That's over a gigawatt. Lordstown, Ohio, is aiming for 1.5.
And they're going international, too.
They have to.
Yeah.
1 gigawatt in the UAE, and they're chasing cheap hydroelectric power in Norway, up to 520 megawatts there.
So if you unpack the strategic logic, Oracle is basically prioritizing what they call temporal advantage over cost optimization.
It's a beat over everything.
Right. They're locking up all the NVIDIA hardware with these aggressive forward commitments. The thinking is that being the first mover here creates exponential returns that will eventually just dwarf these massive upfront costs.
But that speed, it comes with an extreme price tag. And that price tag is what's causing this catastrophic capital inversion for the company. Oracle is a cash machine for decades.
Right.
Now, analysts project their annual CapEx, their capital expenditure, will hit somewhere between $60 and $80 billion by fiscal 2028.
That is just a complete reversal.
It is. The cumulative spending could top $400 billion through 2029. And that profile, it just completely inverts their historical cash flow. They are trading a stable, reliable checking account for a massive leveraged construction loan.
And you can see that pain so clearly in the Q2 2026 financials. For the quarter that ended November 30th last year, they generated $2.1 billion in operating cash flow, but they deployed $12 billion in CapEx.
Which leaves you with
a negative $10 billion free cash flow for a single quarter.
the deepest cash burn in their entire corporate history. I mean, just contrast that.
Yeah.
For the entire previous fiscal year, they generated a positive $20.8 billion in free cash flow. They've totally flipped the script.
And that $10 billion hole doesn't even tell the full story because they're leaning so heavily on off-balance sheet financing, mainly leases, to build this stuff out faster.
That's the hidden risk. Those lease obligations for the data centers, they just exploded. They hit $248 billion by November 2025.
That's a 148% increase in 3 months.
Insane. And functionally, that's quasi-debt. It commits them to future cash outflows no matter what, whether or not the AI infrastructure ever generates the revenue to pay for it.
So let's talk about the credit market's reaction, because this is where the alarm bells are really ringing. How is it that Oracle is still technically investment grade?
Well, that's the key question. The credit market is signaling that the risk is systemic. You have rating agencies like S&P and Moody's, and they incorporate those massive leases as economic debt. When they do the math, Oracle's adjusted debt-to-EBITDA ratio gets pushed up close to 4 times.
And for a company like Oracle, that's a huge red flag.
It's a fundamental violation of their traditional risk profile. It pushes them into the territory of, highly leveraged industrial companies. This isn't a software company balance sheet anymore.
And you see it in the markets. By December, Oracle's credit default swaps the cost to insure against their default hit 128 basis points. That's the highest it's been since the 2008 financial crisis.
And it gets worse. They're longer-dated, 30-year bonds. They're reportedly trading around 65 cents on the dollar. That's a huge discount. And it signals deep concern about that peak cash burn period in 2027 and 2028.
So they're still investment grade Bay to BBB, but on a negative outlook, just 2 notches above junk status. Management keeps saying they're committed to staying investment grade.
But how? How do you do that when you have to fund $50 to $80 billion in CapEx a year without the cash flow to back it up? It's incredibly difficult.
Which brings us to the really fundamental problem here. The margin collapse. This is why the market is in shock.
That's the structural reason, yeah. Oracle's legacy software business ran on these incredible gross margins, near 77%. Selling intellectual property is very profitable.
But building and running massive, power-hungry AI data centers
is a totally different economic model. It compresses those beautiful margins all the way down to a projected 45 or 50%.
So Oracle is trading high-profit, stable software value for the compressed, almost commodity value of data center hardware. And that flows directly into negative operating leverage, with projections of a cumulative negative free cash flow of around $34 billion through fiscal 2028.
And that extreme financial pressure brings us to the single biggest operational risk of all: customer concentration.
The numbers here are just dizzying. The projections show that by 2028, a single customer, OpenAI, will account for about 1/3 of Oracle's total revenue.
1/3.
The billion-dollar commitment from them breaks down to roughly $60 billion a year, starting in fiscal 2027. To put that in perspective for you, that one contract is bigger than Oracle's entire revenue for fiscal 2025, which was $57.4 billion.
It's a profound asymmetry. Oracle is financing its institutional survival on payments from one customer. And OpenAI's ability to pay depends entirely on its own success, which is, let's just say, opaque and volatile.
Reports suggest OpenAI lost over $5 billion last year.
Right. And its revenue has to grow 16 times, from about $3.7 billion in 2024 to over $60 billion by 2028, just to meet its obligations to Oracle.
16 times in 4 years is an astronomical growth rate, and you have all this competitive pressure building. We saw those reports in December that Sam Altman declared a code red at OpenAI because of threats from Google's new models.
If they lose their competitive edge, that whole revenue thesis just collapses. And then what?
On top of all that, you have execution risk. You can't solve physics with financial engineering.
Exactly. We're already seeing reports of delays. Several Stargate sites scheduled for 2027 are now pushed to 2028. Labor shortages, material constraints.
I saw a great quote from a data center researcher, Jonathan Kumi. He said, "The world of bits moves fast. The world of atoms doesn't. And data centers are where those two worlds collide."
That's perfect. And every delay just compounds their interest costs and pushes out the revenue they so desperately need.
So to really understand the scale of the gamble here, we have to compare Oracle to Microsoft, OpenAI's other big partner.
And the contrast could not be more stark. It really shows you the value of a fortress balance sheet. Microsoft has a AAA credit rating, the highest you can get. They generate over $70 billion in positive free cash flow every year.
Their own capex for fiscal 26 is huge, maybe up to $140 billion, and this is the critical point, they're funding all of it from their existing operations. No new leverage needed.
And that gives Microsoft something Oracle completely lacks: strategic optionality. Microsoft's revenue is wildly diversified. They have over 80,000 Azure AI customers. They capture value up and down the AI stack with products like Copilot.
Meaning if AI demand slows, they can just dial back the spending.
Precisely. They even authorized a $60 billion share buyback in December, which is just a massive signal of financial confidence.
While Oracle has, as our sources put it, forfeited flexibility, they have this extreme concentration risk, a third of their future revenue tied to one volatile customer and a 4x debt ratio. And yet,
Here's the paradox.
the market is pricing Oracle at about 26 times earnings, which is relatively close to Microsoft's 35 times earnings.
Which suggests the market might be fundamentally mispricing the underlying risk here. They might be looking at the potential AI payoff without fully accounting for the sheer leverage and fragility required to get there.
So this all boils down to two competing theses, right? The bull case versus the bear case. Let's start with the optimistic view.
Okay, the bull case. It rests on three pillars. First, indispensability. If Stargate actually works, if it trains these transformative AGI models, then Oracle has built something irreplaceable with enormous switching costs.
Second, the operating leverage flips back in their favor eventually. If they hit their 2030 revenue projection of $225 billion, that will generate massive cash flow, allowing them to pay down debt super quickly.
And third, portfolio expansion. It's not just OpenAI. Oracle claims they have over 700 AI customers. There are rumors of a $20 billion plus deal with Meta. The argument is they can redirect this capacity if one customer falls through.
Okay, now for the pessimistic view, the bear case.
Which focuses on the fragility. First, monetization uncertainty. The economics of AGI are totally unproven. What if open source models commoditize AI? OpenAI's projections could collapse, leaving Oracle with billions in stranded assets.
And second, there's timing risk. Oracle might not even survive the 2026 to 2028 cash burn. A credit downgrade would trigger higher borrowing costs right when they need money the most.
There was a great analyst quote in our sources. They said Oracle is, quote, in this tough situation where they have to build out capacity for this customer and borrow a lot of money to do that, when there's a very high uncertainty this customer will be able to pay.
And we can't ignore the political dimension. The White House framing this as essential infrastructure, that's a double-edged sword.
Absolutely.
Yeah.
On one hand, you could see implicit financial guarantees if it's deemed too important to fail. On the other, it exposes them to political reversals, trade wars, all sorts of risks outside their control.
But maybe the biggest constraint of all isn't capital or politics, it's physics, it's energy.
The 10 gigawatts of planned capacity. That's in direct competition with the public grid, with electrification, with residential demand.
Which creates these critical dependencies that money just can't solve. Like, what's the manufacturing lead time for the huge transformers they need?
They can be 4 to 5 years. And if you can't get the transformers, the data centers are just empty shells burning through interest payments on hundreds of billions of dollars of debt.
So when you synthesize all of this, it really comes down to one core truth. Oracle has made a calculated wager that the first company to build this AI infrastructure will capture almost all the value.
But to make that wager, they accepted risks, leverage ratios, customer concentration that violate, frankly, decades of standard corporate risk management.
The company is now a leveraged speculation on the economics of AGI. Full stop.
And its success or failure depends almost entirely on three external factors they can't control. 1. OpenAI's ability to grow 16x and pay its bills. 2. The credit market's willingness to keep funding them through 2028. And 3. The absence of some technological leap that makes all this hardware obsolete.
Oracle has staked its institutional survival on outcomes it cannot control. If the bulls are right, they become the essential backbone of the AI economy, the new AWS. But if the bears are right, they risk becoming a cautionary tale of strategic ambition just completely unmoored from financial reality.
And that forces you to consider a bigger shift. This pursuit of civilizational scale tech is blurring the line between conventional corporate finance and strategic national infrastructure. That's a profound change in how we think about corporate risk, and it's going to affect every other major player chasing this frontier.